Responsibility in business is as much about accountability. And in last week's I Hate Numbers video, I looked at responsibility accounting, specifically the 4 main types of responsibility area that you can have in your business. We looked at the rationale behind them and what we're looking to achieve by having those responsibility centers. In this week's video, as a follow-up to last week, I'm going to be looking at the measures that we can adopt, KPIs if you want to add a little bit of terminology there, key performance indicators. I'm going to go for each one and suggest some KPIs that can be used in those centers. Ultimately, the choice of the KPI is dependent on what you think is important to look at, to monitor, to measure, to improve the performance in your business. With those 4 centers in mind, folks, let's move on. Now, if we look at the cost center first of all, and that is where an individual or group of individuals are accountable for costs, managing those costs the best they can. It's a department or a unit within your business that incurs expenses without directly generating revenue. Typical examples of those cost centers could be HR, IT, let's not forget the accounts function, and administration. Now, 3 samples KPIs that I've listed there. One is to look at the change of cost over a period of time, and that period of time could be a week, it could be a month, it could be over several months, or it could be compared to last year. Choose the time frame that's appropriate for your business. Now, the calculation, we look at the current cost we have. Now, that could be a summary of the cost that we have, from cost of sales down to overheads. We can look at on a cost by a line by line basis. You make that choice as to what's going to give you most valuable input. Look at the movement of the cost between those 2 periods, and that measures the effectiveness of any cost-saving initiatives we have and identifying areas for improvement. Typically, it's expressed as a percentage. One place is perfectly sufficient. The next KPI that we adopt in our cost centers is to look at budget variances. Now, a budget is our expectation, what we think is going to happen based on a certain level of activity. The actual is the reality, and what we want to do is to compare actual against reality. Now, the significance of this variance, it tracks how well our department, our managers are managing their expenses, revealing whether they are in or owe the budget. The interpretation of those variances is a topic for another video, and if you check the library, you'll see some historic videos that have been published that dive deeper into that topic as well. Now, the last KPI is looking at how much of our capacity is used up to deliver services, to deliver product. One example of a KPI that we can use is capacity usage or capacity utilization. Doesn't that sound magnificent? So we look at the output that is being generated, whether that's physical product, whether that's the sale of products if we're a retailer, whether that's delivery of services, and we look at the time that we've got available to see how much of that is being used up. That will pinpoint any inefficiencies, pinpoint utilization, and pinpoint areas that we can focus on to drive our improvement. Now, if we move on, let's have a look at the revenue centers. Now, revenue centers is where we are effectively allocating to maybe a marketing department, a retail store, or equivalent, where somebody is going to be responsible and accountable for generating sales. Typically, as we said, those sales departments, marketing teams, and retail stores. Now, 3 sample KPIs that we have is to look at the growth of revenue. Again, choose the time period that's most effective for you. I would certainly recommend for most businesses, the minimum time period that you look at is what the movement has been over a monthly basis. I have myself worked in industries, in a retail environment, in hospitality, where it's very much fast moving, and we looked at sales movements over a weekly and sometimes a daily basis. Now, the significance of this KPI, it gauges how effective we are in terms of our strategies for increasing revenue, where there's a shortfall. And as a spoiler alert, folks, so I'm going to round up at the end, a number in its own right is quite meaningless here. All we're looking at here is generating KPIs. How we use them, how we utilize them, how we make them more effective requires things such as benchmarking, comparative numbers, targets that we set ourselves, and that's how we ultimately use those KPIs. But here, we're merely giving an overview of the potential KPIs that we can adopt. Now, in a revenue center, notice we're using here KPIs that are suitable for that area, we can look at something called sales conversion rates. Now, the calculation is we look at the number of leads that we've received. If you have that data, you can divide that into cold leads or warm leads, and we look at how many sales that we're generating off those leads. Those leads could come off our website, they could be direct referrals, they could come from a number of different sources. Now, this measures the ability of our centre to turn those prospects into paying customers, what we all like. It provides some insight into how effective our sales and marketing efforts have been. The last sample KPI I've mentioned here is what's called customer acquisition cost. Doesn't that sound really wonderful? Now, this is looking at the total marketing and sales costs against how many customers we've acquired. You can break this down onto a monthly basis. You can look at it over a 6-monthly basis. Choose the time frame that's more suitable. Now, that will tell us the effectiveness of the spend that we have in acquiring new customers, seeing how effective we are. And again, remember, to give it more meaning, we can set a target. The focus of this video is looking at the metrics that may be suitable. We adapt the metrics to the area of responsibility that we are looking at. Now, our third responsibility centre, don't you just love that term, is a profit centre. Now, that is where an individual or individuals are responsible for cost control, revenue generation, and ultimately the profit that gets generated from those activities. Typically, this would be somebody who leads up a division, somebody who leads up a subsidiary. It could be somebody who's managing a product line. And 3 sample metrics here that I've adopted is looking at gross profit margins. So that's the difference between what we sell something for, the revenue, and the cost of sales associated. So if it's a manufacturer, it'll be the cost of manufacturing labour, the cost of raw materials, and the cost of production overheads. If we're a retailer, it's the cost of buying in that product, and we express that as a percentage. What we're looking to do is to maintain that as a healthy number. Now, this measures the profitability of that product or service. This provides the funds, by the way, to cover our overheads and to feed into the ultimate net profit. So we can evaluate how effective our strategies have been, our production flow, our efficiencies, our level of wastage, and the like. The second metric I've listed there is what's called the operating profit margin. Now, accountants being what accountants are, we might call that operating profit margin net profit margin, and that's perfectly fine. We love to invent different terms for the same item. The calculation, we look at the revenue that we're generating, we deduct the operating expenses, what you might call support costs or overheads, typically things like salaries, rental costs, marketing activity, professional fees, distribution costs, and the like, and we work that out as a margin. Now, the relevance of that one, the significance, is the ability to manage those costs effectively from our core business operations, revealing how efficient our managers have been. Do not include anything like interest or tax charges. That's outside of an operation manager's responsibility. The last metric suggested there is operating expenses to sales. And again, we take those level of support costs, those operating costs such as salaries and rent, marketing costs, distribution, and the like, and we divide it into the revenue that has been generated. Now, the significance is about cost control, managing those costs, and seeing how efficient we are and what the economies of scale are likely to look like. Now, folks, we've come up to the last one. This is called an investment centre. Now, this is where typically it's felt at divisional level, it's felt at subsidiary level, where ultimately management are responsible and accountable for the decisions they make of investing and buying fixed assets, what's called working capital, and therefore we want to make them accountable not only for all the other elements of profitability, cost control, revenue generation, but ultimately how those resources have been deployed to help generate the returns that we want in our business. One common calculation is ROCE, which stands for return on capital employed, or one that is meeting more favour these days is return on investment, ROI. We look at the operating profits that have been generated, and we look at the underlying capital that's been invested in our area of responsibility. Typically, the fixed asset spend plus the working capital is one way of defining the capital. Define what capital is for your organisation and be consistent. The next calculation is called a cash conversion cycle. And old money, that was called a working capital cycle. Now, there's 3 elements that make up that cycle. Let's assume a manufacturing company. Inventory days is effectively how long it takes to convert raw materials into a product and get it out the door, get it out the warehouse. Receivable days tells us how long it takes customers to pay from the day the invoice is generated. And payable days is the opposite side, how long we will take to pay suppliers from the issuing of the invoice from them. In an ideal universe, we're looking for inventory days to be as small as possible, receivable days to be as small as possible, and payable days to be as long as possible. Now, if we add those up in terms of timing, that gives us a cash conversion cycle from investing in that and buying that raw material to getting paid ultimately by our customers. We look at that as a cycle, and we measure that typically in number of days. Now, the last calculation I've got here is called residual income. If you are a divisional manager, if you are heading a subsidiary, you're accountable ultimately for the assets at your disposal. So what we want to know, we will have this idea that all money that's been invested in the company carries an associated finance cost, or we might call imputed interest. So whatever level of operating margin is generated, we deduct the expenses, and we also deduct an associated interest charge. If the number is positive, that's a thumbs up. If the number is negative, that's not such a good look for us, and we don't like that. Now folks, just as a summary, we've seen 4 cost centers, we've seen some sample KPIs, measures that we can associate with each of those centers, and it's important to remember this. Number 1, the KPIs is what's important for your particular business. I've given you 3 examples in each center. You need to consider what is the most important aspect of performance you want to measure, what makes the biggest difference to your bottom line. Number 2, we need to make sure that we associate measures with those areas where managers can have an influence and an impact on what we're looking to judge them by. And the last thing, the numbers in themselves, a single number, is completely meaningless. You need to have a context, you need to have a comparator. So the targets that we set ourselves, that's what we're monitoring ourselves against. Maybe we're looking at last year's figures and we're measuring performance against that. And as long as you've got a accountability measure and some form of context, those numbers can be very powerful for you in your business. Folks, I hope you found this video of use and of value. I'd love it if you give some feedback and comments and share it with those who you feel could benefit. If you feel there's a topic in the I Hate Numbers video production cycle that you'd like covered, let me know. And until next week, folks, I'll see you on the other side.